Okay, today we're looking at the questions of how investors should look at uh, and prioritize investing in, say, like a high yield savings account, which are providing pretty good rates currently, or investing in the stock market. And along with that is now the time to put more money into the market and try to earn a return that outpaces inflation, because inflation is a hot topic right now. It's cooling a bit, but it's still high. And then is the yield on savings accounts, too good to pass up? So let's just see what are the current yields on savings accounts. And I'll share here just a Google search of, current rates. This is an article, 7 best high yield online savings accounts in April of 2023. And if we scroll here to the bottom, we could see that they're around 3.75 all the way up to like 4.5. You might be able to find a 5% depending on, what their bonuses or parameters are. But 3, 4, 5% on online savings accounts, which is just cash, is pretty good, especially when you consider like some of the bigger banks checking or savings accounts like Wells Fargo, Bank of America, Chase. Their interest rates are like almost nothing, 0.01%. So a lot of people might be looking at this and saying, hey, now's the time to save and put money in high yield savings accounts. And you wouldn't be wrong. It's never a bad idea to put cash away. But then some people are saying, well, what if I put it into the stock market, quote unquote, the stock market, and we'll just look at like the S&P 500, again, another just article that shows average returns. You can Google search, and it looks like for the S&P 500, which is the index of the leading 500 publicly traded companies in the U.S., it's approaching 10%. So that's the average total return, reinvesting dividends. That's going back to 1928. It looks like 1957, 10.15. But depending on the time frame you use, 10 years, 20, 30 years of looking at what the stock market has returned, you could get anywhere from 8, 9, 10%. But either way, it's about double the annual average return, average keyword. It's not every year. It's about double the return of what the savings rates are for the high yield savings accounts. The S&P 500 invest. These are like examples of the companies here as of April 17th. The top companies, the S&P 500. So when you invest in, just for example, I'm not recommending this, but the stock market could mean many things for different people. The S&P 500 is just one index. There's the Dow Jones, which is 30 companies. There's the NASDAQ, which is tech weighted, and tons of other indexes. But S&P 500 is kind of like one of the famous ones, and you're investing in companies like Apple, Microsoft, Amazon, all the way down. You got different ones, Amgen, Intuit. Let's see who's at the bottom. I think it's like Dish Network, First Republic Bank, Ralph Lauren, Alaska Airlines. So all types of companies, some that are doing really well, some that aren't doing so well. But the question is, how do you decide which one to invest in? And I'll go back to sharing my whiteboard here. One thing to consider at the front end is, what is your time frame and what are your goals? What's important to you? So when it comes to weighing the pros and cons, high yield savings accounts are just safer. They're banks. They have FDIC insured insurance, and it happens to be at around, we'll call it like 3.5 to 4.5% on your money. And I like high yield savings accounts because they're liquid, meaning you can access the funds quickly and not lose any market share or market value. What you see in your account is what you get. There's not going to be fluctuations up and down like the stock market. Whereas investing in the stock market is you're going to have fluctuations, and you might be able to get something like 10% on average, but each year you could experience on average double digit drops. So I think on average, going back 30, 40 years or so, you can expect a 14% drop intra-year on average. And then every 4 or 5 years, you can expect a bear market, which is a negative 20% or more drop roughly every 4 to 5 years. And then just even the last 25 years, we've had multiple 50% plus drops. So you got to be able to like stomach those fluctuations, which is why I say a big determining factor isn't what the rates are necessarily, but more like what's your time frame. And excuse the if there's any typos. What's the purpose for the money, right? If you have money that you possibly need within the next few months, stock market probably isn't a good idea because you could experience these drops at any given moment, and you'd hate to have less money than what you started with within a short amount of time. 10% is the average annual. However, you wouldn't really want to put it in a high yield savings account if you have decades that you want to invest this money and have it work for you as best as possible, because that's roughly half of what the return is. This is for a savings account, high yield savings annually. Let's look at the next question here. Is now the time to put more money in the market to try to earn the return that outpaces inflation? I mean, it's always a good idea to be investing, right? And inflation is kind of the silent killer, if you will, of a financial plan, because the money you need today isn't going to be all you're going to need in 10, 20 years in terms of what things cost. So you want to have a mechanism for keeping up with inflation. So the market is a great way to do that. Is now the time to put it, in the stock market? I think it's always a good time to be considering what amount of your cash flow should you be putting towards the stock market, without being dictated by the economy or the current, market outlook, because you never know what's going to happen in the future. A lot of people expect the market to go down and it goes up. People expect it to go up and it goes down. So it's more about the consistency of being in the market and trying to get that average of 8, 9, 10% per year. And is the yield on savings, too good and safe to pass up? Well, you should always have some sort of, I've got to be careful saying should, because, everyone's plan is different, but it's a good rule of thumb to have a cash reserve for emergencies. And again, that's based on your plan and your situation, but 1 month of expenses is definitely a great starting point, and then getting towards 3 to 6 months of expenses of a cash reserve. So if your expenses, let's just say, is 5,000 per month, set a goal of putting aside 5,000, and you could put it into a high yield savings account to get a little bit more bang for buck, 3 or 4% versus 0.01 at a bank account. And it's good to have them in a separate bank account anyways, just so that way the money is being separated from your day-to-day living to your cash reserve. And then, maybe once you get to 3 to 6 months, maybe your goal is to get to like 12 months, depending on, how close you are to like retirement, or if your job situation maybe is shaky or there's layoffs happening. Of course, it's better to have a longer runway than a shorter one if or when your income is not coming in the way you expected it to, or there's a big calamity. There comes a point where, how much cash is too much in terms of missing out on opportunities for improving the return. But that gives you a starting point for looking at the question of weighing out the pros and cons of, high yield savings and investing in the stock market. My name is Eric Maldonado, owner of Aquila Wealth Advisors. You can reach us at aquilawealth.com, AQUILA. Until next time, thanks for listening.